Hi guys, my name is Rahul Jain. I'm a SEBI registered research analyst. Whether stock market is in bull run or bear run, AMCs or mutual fund businesses in India continue to grow their profits as well as their revenues. For example, SBI Mutual Funds, the largest AMC in India, and their IPO is about to come in the next few days. If you look at how their revenues have grown in the last 2 financial years, it has grown by around 27% CAGR basis. If you look at their profit after tax growth rate, it is around 21% in the last couple of financial years. And let's admit, in the last 18 months or so, Indian stock market has not been in bull run, but still AMC businesses have been continuously growing. Now, as an investor, should you bet on AMC sector or not? So in this video, I'm going to talk about 4 critical points. Point number 1, what are the tailwinds in the AMC companies and what are the future prospects? What is the market size of this particular segment? Very, very important data points I'll talk about. Point number 2, I'll speak about SBI Mutual Fund, the largest AMC. Their IPO is coming up. So I'm going to talk about that. Also, we'll compare SBI Mutual Fund's fundamentals with all other listed companies like ICICI, HDFC, etc. Point number 3, I'll also speak about valuations and I'll teach you one very, very important concept that nobody is talking about even today. And lastly, we'll look at a couple of risks so that you get totally unbiased view about AMC stocks in India. It's going to be a super important video full of data backed analysis. You're going to love this. With that, let's get this video cracking. So let me start with the first point, which is what are the tailwinds of AMC stocks and what is the future opportunity. Allow me 2 to 3 minutes of time. See, what is happening right now in India is that a lot of people are taking out money from their bank deposits, be it the fixed deposit or the normal bank deposits, and they are putting it somewhere else. For example, if I show you the data of banks' loan growth rate versus deposit growth rate, you will see a stark difference here. See the blue line here, this is the bank's loan growth rate. And see the purple line here, which is showing you the deposit growth rate. There's a big difference between these two lines, meaning that deposits are falling down as compared to the loan growth rate. In my view, this is primarily happening because a lot of people are putting money into, for example, mutual funds. Have a look at my screen and you see the SIP flows in India. At the time of COVID, it used to be around 1 lakh crores of inflows. It has gone up to almost 3,50,000 crores by FY26. That is almost 3.5 times growth in mutual funds. And mind you, in the last 18 months or so, Indian stock market has not done well. Still, the SIP flows have continuously gone up, as you can see, April data for May 2026. Now, if you see the Indian household savings and where the money is going out, clearly, if you see between fiscal year 2022 and 2025, mutual funds have grown at around 42%. So the share of mutual fund is growing in Indian household savings bucket. And precisely this is one of the reason Indian mutual funds AUM has been growing at a staggering 24% CAGR basis between FY20 and 25. This is a very, very healthy growth rate that we have seen in the last 5 financial years. As of May 2026, Indian mutual fund industry's AUM, asset under management, have gone up to 83 lakh crores. And the day is not far away that it might cross 100 lakh crores. On top of this growth, if you look at the margin profiles of some of these AMC companies, they are very, very high. For example, if you look at SBI Mutual Fund's margin profile, PAT margin is around 61.65%. Tell me how many businesses do you know where the PAT margin is more than 60%? Very, very few. But these companies are churning very, very good PAT margin. Now, could this trend continue in the future or not? Because this is all past data. Well, in my view, if you look at this data and you see what type of financial savings people are doing nowadays, focus on the bank deposits. So the bank deposits have come down from 57% of the overall household savings to almost 35% in 24-25. So bank deposits are declining. While if you look at this orange color bar here, which is shares and debentures, it is still only at around 15% as of FY25. This is provisional data. So there is a very, very long runway from here on where more people might put their money into stocks using mutual funds or direct stocks, because as of now, this ratio is only around 15% as of financial year 2025. So overall, mutual fund industry is growing at a fast rate. And if you look at the future prospect, it looks very, very bright to me. Now, let me know in the comments, what is your view on mutual fund industry growth rate? I would love to read your comments. With that, now let's move to segment number 2 of this video, which is all about, let's have a look at SBI Mutual Fund's IPO that is coming up in the next few days and compare this company with other listed players fundamentally, so that we understand which companies are growing at a faster rate, which is a quality company, which is not a quality company. And more importantly, let's also find out whether the SBI Mutual Fund IPO is a hype or this is a good IPO to consider. So SBI Mutual Fund IPO is going to be launched very soon, and it is likely to raise around $1.2 billion. IPO dates have come out, and the IPO is about to come out between 14th July to 16th of July. The issue price band is between 545 to 574 per share, and this is completely offer for sale, where the promoters, for example SBI and France-based Amundi, they are going to dilute around 10% of their stakes. Now, is the issue price 545 to 574 is a good one or not? Before that, we need to really understand the fundamentals of SBI mutual funds, and we're going to compare this with likes of ICICI, HDFC, Nippon, etc. Allow me a few minutes of time. I'm going to share with you a lot of data points so that we can conclude which AMCs are quality ones and which are not so quality ones. Now, what you will hear from media is that SBI Mutual Fund is the largest AMC in India by AUM, which is fine. There is no question about it, but what media is not telling you is something that I want you to have a look at it. What you see is SBI Mutual Fund's total quarterly average AUM, which is around 29 lakh crores. Now, out of this 29 lakh crores, the total mutual fund AUM is around 12 lakh crores. So that is around 43% only. The remaining AUM, if you have a look at it, you will see that PMS and advisory is around 16 lakh crores of AUM, which is around 55% of the total AUM. Meaning what? Actually, SBI is number one PMS in India. Have a look at this data. They are number one PMS in India. PMS, I hope you know, Portfolio Management Services. And you see that SBI hold around 39% market share in PMS business. Now, this is very important because SBI is not just a mutual fund AMC. They also have a PMS business, which is as bigger, even higher than the mutual fund businesses, as I have shown you the data here. Now, what makes SBI number one PMS in India? Okay, another important point that you need to know is that this is all about PF, the Provident Fund, and Employee Fund, EPFO, that is driving the AUM in the PMS business. For example, if I talk about the ratio of PF and EPFO here, out of 16 lakh crores, almost 15 lakh crore is the PF and EPFO, which is around 91.9% of their PMS business. So the majority of their PMS business is coming from institutions like Provident Funds. And the market share that this company holds in EPFO is around 49.9%. Now, this makes SBI Mutual Fund very different from companies like ICICI, HDFC, because there the PMS business is not as big as what I've shown you here from data. But if you look at the revenue of SBI Mutual Fund, 85% of their revenues come from the mutual fund segment, and only 3.11% of their revenues come from the PMS side of the business. This is also very important data point. Now you would wonder why this is happening. The PMS business is around 55% of the overall AUM, but only giving them around 3% of revenue. Why is this happening? See, the simple explanation is that the PMS business, especially the Provident Fund or EPFO business, is a very low margin business. It is completely controlled or governed by government policies. For example, until 2021, NPS, National Pension Scheme, the regulatory fee on NPS was only 0.9 basis point. Of course, in the last few years, it has gone up to almost 12 basis point, meaning almost 12-fold jump has happened in the NPS scheme fees. And this is where I say that if the Provident Fund and EPFO business of SBI Mutual Fund, if they can generate better margin here, because maybe the government policies may change in future, we don't know whether they will or they will not. But if that business segment start to give them the margins, then clearly SBI might be ahead of many other AMCs like ICICI, HDFC, etc. Again, there is no guarantee that this will happen or this may not happen. It is really entirely dependent on government policies. But as of now, I really wanted you to understand that the PMS business of SBI Mutual Fund is very large. Of course, it is a very low margin business as of now. And in future, we do not know whether this could become a better margin business or not. That really depends on government policies. But overall, I wanted you to understand this point that nobody is talking about. I hope that point is clear. Now, let me go through and compare these AMCs on the mutual fund businesses basis. So here is some comparison for you. If you look at the number of unique customers, Nippon AMC has the highest number of unique customers at around 23 million, followed by SBI AMC at around 18. And then you have ICICI Pru and HDFC AMC. If I talk about the distribution reach or distribution power, then clearly SBI is number one, distribution partners at around 1,32,000. At number two is Nippon, 1,23,000, then followed by ICICI Pru and HDFC. Now, if I talk about the asset under management AUM, then SBI is number one, taking a market share of around 15.3% as of March 2026. And if you look at the growth rate of this, then clearly the growth rate in AUM is better in case of ICICI as compared to SBI. Of course, there are other companies as well. For example, Tata AMC that has shown a growth rate of around 29% in AUM, but they are not listed yet, right? So if you compare with listed players, then clearly Nippon is at number one at around 26%, followed by 22% by ICICI, and then you have SBI at 19%. Now let's come to second parameter, which is operating revenue. And from a growth rate perspective, in the last 3 financial years, if you look at the growth rate, you will see that ICICI has been growing fastest at around 28% versus other companies. SBI is also growing at around 26%. Now, the next point that we need to speak about is the operating profit. Which AMCs are generating better operating profit growth rate? So on that parameter, SBI is doing slightly better than ICICI. You can see the growth rate in the operating profit has been around 31% CAGR versus ICICI 30%, HDFC at 27.3%, Nippon at around 31.9%. These are the 4 top listed companies when it comes to AMC businesses. So you can see the growth rate comparison here in terms of the operating profit. Now, if you look at the PAT, profit after tax, then here clearly SBI is doing better than all other listed players. Okay, 31.8% growth rate in the PAT. Then you will see ICICI at 29.6%, HDFC 26.2%, and Nippon 28.3%. Again, you see Tata is doing much better, but they are not listed as of now. Now let me talk about very interesting data point, which is return on equity. Extremely important data point. Okay, what you see on my screen is, if you look at the ROE, majority of these companies' return on equity has been going up. But interestingly, if you see ICICI Prudential's return on equity, it is as high as 85%. Tell me how many businesses in India are generating a return on equity of around 85%. And you must be curious, how come ICICI is generating 85% ROE, which is the best in the industry as compared to SBI, which is the largest by AUM, growing the fastest from a PAT perspective? I'll tell you the reason that nobody is talking about. Okay, it is all about the dividends. So you see on my screen the data point. So this is the dividend that ICICI Pru has been paying in the last few years. Okay, around 84% dividend payout, 76%. So majority of their PAT, what do? They actually pay out in dividends. Okay, now don't go and look at the dividend yield. That's a different topic for altogether some other day. But here note that majority of their profits they are paying out as a dividend. Why? Because they don't know what to do with this money, right? Now, when a company pays a lot of dividend, what happens? The equity comes down. Because if I am getting 2 rupees dividend and I only had given 100 rupees of equity to the company, I've got 2 rupees back, so my equity will go down, right? By 2 rupees, so my equity will now become 98 rupees, right? Likewise, because they have been paying out a lot of dividend, the equity has been coming down. And what is the formula of return on equity? Net profits divided by the equity. So if equity come down, what happens? Your return on equity goes up. So this is mechanically inflated ROE in case of ICICI, mainly because their dividend payout has been very high in the last 3 years or so. Now, just because ICICI has been paying out a lot of dividend, their ROE looks very high, mechanically inflated. Now, there's nothing wrong in it, right? Because if a company is giving dividend, it's fine. Shareholders are happy with that. But I really wanted you to have that context here that ICICI's ROE, not because that if you put more equity into the business, they are giving more profits. That is what is the ideal situation we want from stocks. But here the situation is very different. This is a very solid concept that nobody is going to teach you. Here, practically, my intention was to teach you this concept so that whenever you are comparing the return on equity between AMC stocks, you are not getting confused that maybe ICICI is better than SBI. Why? Because their ROE is better. No, it doesn't work like that. Here I have explained to you that just because they have paid out dividends, their ROE looks very high. Tomorrow, if SBI does exactly the same, if they pay out large dividends, right, their ROE will also look like 80 to 90% or whatever, right, depending on how much dividend they pay out. So this is important point that you need to understand. Now, my last point on fundamentals, then we move to valuation. So you see on my screen here, in terms of if I were to conclude SBI's position in the AMC segment, they are leader in terms of the mutual fund AUM. They are leader from a ETF or passive AUM perspective. They are number one. From B30 monthly average asset under management, they are also number one. Now, what does B30 means? B30 simply means beyond 30 cities in India. Okay. So there are T30 meaning top 30 cities of India. Then you have beyond 30, which is beyond these 30 cities in India, right? So beyond these 30 top cities, SBI is at number one. Now this is important. Why? Because it tells you that SBI is trusted more in the rural side of the India. Okay. That is what I want you to understand. And as of now, the urban market, in my view, is slowly getting matured. In the next few years, it's likely to get matured. And the growth in mutual funds is likely to come from tier 2, tier 3, tier 4 cities. So if tomorrow mutual fund AUM growth is coming from tier 2, tier 3, tier 4 cities or the towns of India, then SBI as of now has the strongest point. Now let's move to the valuations. Okay. Where does SBI's IPO stack in terms of the existing listed companies valuation? Okay, so I did some calculations here. So we know the IPO issue price band is between 545 rupees and 574. So I've done the calculations for both the price points here. Based on the earnings per share as of March 2026, the PE ratio diluted basis comes around 36 at 545. And at 575 around 38p. Okay. Now, if you look at the price to book ratio here, that is coming at around 18 times to 19 times, right? Let us now compare this with other listed markets and also compare this with other wealth management companies. Okay. So for example, here you see on my screen ICICI Pro, right? Their PE ratio at the time of recording this video is around 47. So SBI from a PE perspective is less than ICICI. So ICICI is listed at a higher P as of now, right? And from a price to book ratio perspective, ICICI is at 33 multiples while SBI is at around 18 to 19 depending on the price, right? So from a ICICI's comparison perspective, SBI is likely to get listed at a cheaper price depending on what is the exact price here. But if you look at with other wealth management companies likes of, for example, BSE's current PE is at around 61, Geo Financials at 97, HDFC, if you look at HDFC Asset Management Company, 39 PE, so slightly lesser than HDFC as well. And from a price to book perspective, HDFC is slightly better, 10.5. Okay. Likewise, you can pause this comparison and see where the PE ratios are trading right now, and you can make sense out of this data in terms of whether SBI's valuations are high or low. I'll give you my view in a minute. Let me now come down and talk about only the AMC businesses. The reason I gave you the broader perspective is that you need to understand whether AMC businesses are trading at a better valuation versus maybe exchange or maybe wealth management companies, because if you have limited money, you have to decide, right, where does it need to go, whether it needs to go to AMC businesses or exchange or any other businesses. So that comparison is important. While coming back to the AMC businesses here, what do you see? The PE ratio of, let's say, ICICI 47, HDFC 39, Nippon 48, Aditya Birla 33, UTI 30, Canara Robeco 23. Of course, I've shown you the fundamentals, right? From a fundamentals perspective, I would compare SBI with likes of ICICI, HDFC and Nippon, right? Top 4 AMCs. If you compare between those 4, then clearly SBI's IPO is valued much lower from a price to earnings perspective at around 38 P, right? From a price to book perspective, ICICI is at a very, very high price to book. But why is it so? 33 times PB. Why is it so? Again, the same logic that I explained you. Higher dividends. Because when you pay higher dividends, what happens? Your net worth comes down. Okay, that's the reason. That's the entire reason here. So don't worry about price to book ratio in these cases. It's mainly because of the dividend. Okay. Now compare the PB ratio with HDFC, Nippon, etc. You will see overall SBI, for the quality that it brings, in my view, personal view, not a buy or sell recommendation, not a IPO recommendation here. My view is that SBI is getting listed at a good valuation. It's not that they're getting listed at around, let's say, 50p or 55p, because they are the number 1 AMC in India. Now, what is your view on valuations? Let me know in the comments. I would love to read your comments whether this IPO is a good IPO or not. Just simply type good IPO if you think this is a good IPO. Simply type bad IPO if you think it's a bad IPO. Now, in the next 2 minutes, let me also quickly cover 2 big risks with AMC businesses, right? It doesn't matter whether you're going for this IPO or not, you have to understand the risk of these businesses. Number 1 risk is SEBI's regulatory changes. Okay, very, very recently, SEBI did a lot of changes in the management fees in terms of how AMCs can charge management fees, etc. And due to which AMC stocks were rallying up and down, because it's very hard for investors to find out what is likely to be the impact on the profitability of these businesses. So, point is that SEBI's regulatory changes in terms of how much AMCs can charge on their mutual funds fees, etc., is likely to be a big risk for these businesses, whether it is SBI, ICICI or HDFC. These changes will get applied to all the AMCs, whether they are listed or not listed, right? So that is a very, very big risk. And we all know that the revenues that these AMCs earn, they are dependent on the management fees, which is the percentage of the AUM. So higher the AUM, right, then higher their businesses or revenues are coming from that particular mutual fund AUM, and if the changes happen, then they are likely to get impacted. So this is one of the big risks. It has played out already in the last few months. These are not like very regular or monthly like changes. This could happen structurally. We don't know what the frequency could be, but this is the risk that you need to understand. The second risk that these companies operate with is the market cycles. So all of a sudden, if the market is in a bull run, everybody will put their money in the mutual fund, right? And therefore the mutual fund businesses AUM might go up, their revenues might go up. But on the other hand, if the markets are in the downtrend or in the bear run, then what happens? That people may not put their money in the mutual funds, right? And if people may not put their money in the mutual funds, what happens? The AUM growth comes down, the profitability might come down, the revenues might come down. So that is another risk that you have to consider. So these are the two big risks that I have taken out from their RHP document. You can go and read few more risks so that you are totally looking at this holistically. And my intention has been that I give you totally unbiased view here, because you need to understand what are the opportunities in this segment, which are the finest AMCs, and I've talked about how the SBI IPO stacks up from a valuation perspective as well. Then I've talked about the risks as well. Have tried to do the deep dive analysis for you in this particular video. I know there has been a lot of data that I've shared with you, but share this video with your friends and family so that everybody gets educated about the AMC stocks in India, the future prospects of these businesses. And I hope you enjoyed this video. I'm going to see you in my next video. Until then, keep rocking.